Yes, sir. Very happy evening to all. Sir, we have completed 5 questions out of 7 questions from the cost of capital. We are moving into the 6th question. Kalyanam Limited has an operating profit of 34,50,000. That is, earnings before interest and tax is equal to 34,50,000. And has employed debt which give total interest charge of 7,50,000. Whereas the interest is equal to 7,50,000. Super, sir. The firm has an existing cost of equity, that is KE, is equal to 16% and KD is equal to 8% respectively. The firm has a new proposal before it. Now the firm is going existing. They are having a new project which require fund of how much lakh? 75 lakh. That has to be raised and is expected to bring an additional profit of 14 lakh. So the additional EBIT will be 14 lakh 25,000. To finance the proposal, the firm is expected to issue an additional debt of 8% and will not issue any new equity share in the market. That means only debt. It's a full debt option. Assume no tax culture. You are required to calculate the weighted average cost of capital of Kalyanam before the new proposal or and after the new proposal. Fine, sir. So they have basically given the existing. We are going to analyze the existing, my dear lovable students. Existing, they are having EBIT have been given as 34,50,000. This is existing. From that EBIT, they are paying interest of 7,50,000. So you will be getting earnings before tax, which is nothing but 34,50,000 minus 7,50,000 comes to 27 lakh is the earnings before tax. My dear lovable students, sir, they mentioned that KE is equal to 16% and KD is equal to 8%. Sir, value of the debt is equal to I by KD, as we all know, which is nothing but what is the interest they are paying? 7,50,000 divided by what is the KD? 8%. That means 7,50,000 divided by 8% comes to 93,75,000 is the value of the debt. As we all know that value of equity is equal to EBIT minus interest, because EBT is the amount that can be enjoyed by the equity shareholders. That is the earnings available to the equity shareholders divided by KE, which is nothing but 27 lakhs divided by KE is 16%. So 27 lakhs divided by 16% comes to 1 crore 68 lakhs 75,000. 1 crore 68 lakhs 75,000. My dear lovable students, value of the firm is equal to value of equity plus value of debt. That means value of equity is equal to 1 crore 68 lakhs 75,000 plus value of debt is 93 lakhs 75,000. That means 1 crore 68 lakhs 75,000 plus 93 lakhs 75,000 means 2 crore 62 lakh 50,000 is the value of the firm. That is a total capital employed. Basically, what they want, sir, what is the, sir, WACC before the new proposal? So new proposal, now I am having KD, now I am having KE, now I am having what is the value of the debt, what is the value of the equity, I am having value of the firm, so I can calculate number. There are only two sources are there. Two sources. Number one is equity and number two is what? Debt. Equity and debt. Fantastic to the core. With regard to the source, my dear lovable students, equity and debt. What is the amount of equity? Just now you find out value of equity is 1 crore 68 lakh 75,000. What is the market value of debt? 93 lakh 75,000. What is the total market value of the firm? 2 crore 62 lakh 50,000. I want the proportion because I don't want average capital. I want weighted average capital. So 1 crore 68 lakh 75,000 divided by 2 crore 62 lakh 50,000 into 100 means it's coming some 64.28 percentage. Kacha ka mucha, right sir? So 1 crore 68 lakh 75,000 divided by capital employed. And here 93 lakh 75,000 divided by capital employed. Total should be capital employed, that is 1. So tell me, what is the KE already given in the question as 16? What is the KD already given in the question as 8 percentage? So this is the individual cost of capital, and shall I find out the WACC, which is 16 into 1 crore 68 lakh 75,000 divided by 2 crore 62 lakh 50,000 comes to 10.29 percentage is the weighted KE. What KE? And I don't want KD, I want weighted KD. So 8 into 93 lakh 75,000 divided by, sir, 2 crore 62 lakh 50,000 comes to 2.86 percentage. So basically 10.29 plus 2.86 comes to 13.15 percentage is the KO before the issue of the additional debt. That's what they have also worked out. Value of debt is equal to I by KD, which is nothing but 7,50,000 is the currently interest they are paying, and the current interest rate is 8%. So 93,75,000. Comfortable? So value of equity capital, which is nothing but operating profit. Operating profit is what? IT, EBIT minus interest divided by KE. Right, sir? What is the EBIT given? 34,50,000 minus interest. How much they are paying? 7,50,000. So the equity shareholder can enjoy 27 lakhs divided by what is the KE? 16 percentage comes to 1 crore 68 lakh 75,000. So they are talking about after proposal. We'll come to that, sir. Calculation of WACC before the new proposal, which is equity and debt. Equity 1 crore 68 lakh 75,000 and debt is 93 lakh 75,000. Right, sir? This is the weight, sir. 16% and 8%. Total WACC. So the total comes to 13.15 percentage. Even we also got 13.15 percentage. Right, sir? Now they are going to do some project. Once they do the project, sir, existing EBIT is equal to, what is the existing EBIT? 34,50,000. 34,50,000. Right, sir? Plus new EBIT, once they do the project, they can earn, sir, how much lakhs? 14,25,000. 14,25,000. So the total EBIT will be 34,50,000 plus, sir, 14,25,000 comes to 48,75,000. Comfortable, sir? This will be the new EBIT. Come on, with regard to interest, what is the existing interest? How much interest they are paying? 7,50,000. They said that additional interest, the full new project, which is how much lakh? 75 lakh at the rate of 8%. So 75 lakhs into 8% comes to 6 lakhs. That interest. So totally 7,50,000 plus 6 lakhs comes to 13,50,000 will be the new interest. So my dear lovable students, new EBIT total I am saying is 48,75,000. Comfortable? Less, sir, new interest total I am saying totally 13,50,000 will be the new EBIT divided by, sir, minus, sir, EBT, earnings before tax, will be 48,75,000 minus 13,50,000 comes to 35,25,000. 35 lakh. You tell me, have they injected more debt into the capital structure? Yes, sir. Without increasing the equity. So automatically the equity shareholders' fear would have increased. Equity shareholders' fear would have increased. So the KE will not be how much percent? 16%. So we have to work out the KE, new cost of equity after the proposal. Why? What is the logic? Why we are calculating the new KE? Because to the present capital structure, 75 lakhs debt has been pumped. So if debt has been increasing, automatically the fear of the equity shareholders increases. If fear of the equity shareholder increases, automatically KE increases. What is the current KE given in the question? 16%. Don't expect that 16% as the KE. So now I have to work out the KE. What is the KE, my dear lovable students? KE formula. KE is equal to EBIT minus interest, because that is the amount available to the what shareholder? Equity shareholders, divided by value of equity. Right, sir? That's what KE, market value of equity. Sir, what is the increasing, sir, EBIT? What is the old EBIT which is given in the question? Tuck, tuck. 34,50,000. What is the additional EBIT you can earn? 14,25,000. So 34,50,000 plus 14,25,000, we already find out that 48,75,000 will be the new EBIT. Already we are paying interest of 7,50,000, but in addition to that, once we pump 75 lakh into the capital structure, we are supposed to pay additional interest of 8%. Up 7,50,000 plus 6 lakhs comes to 13,50,000 rupees. Right, sir? So 48,75,000 minus 13,15,000 comes to 35,25,000 will be the earnings available to the equity shareholders. You tell me, have you pumped new equity into the capital structure? No, sir. So the value of equity will not change. Value of equity will be same. We have already calculated the value of equity capital 1,68,75,000. So divided by 1,68,75,000. Comfortable? So 35,25,000 divided by 1,68,75,000 into 100 means 20.9% is the new KE. So new KE is equal to 20.9%. But they have given as new KE, old KE as 16%. Question arises, why sir KE is increasing? Because you are injecting more and more debt into the, then the fear of equity shareholder increases, KE increases. That's why from 16% it has been increased to 20.9%. Very comfortable. Now I am going to calculate the WACC using, sir, the new KE after new proposal. After new proposal, you have to be very careful here. This is the beauty of this question, man. Sir, the equity 1,68,75,000, no change. Why no change? Because we have not raised any equity. Whereas debt, you have pumped debt into the capital structure, and now you are totally paying 13,50,000 rupees as interest. Right, sir? Sir, the interest, so the value of debt is equal to I by KD. Am I right? What is the total I? 13,50,000 rupees is the I, divided by what is the old KD? 8%. Even what is the new KD? 8%. So divided by how much percent? 8%. So 13,50,000 divided by 8% comes to 1,68,75,000 is the value of the debt. Sir, even the value of equity is also 1,68,75,000 rupees only. So the total value of the firm now become 3,37,50,000, and proportion has become exactly how much percent? 50%. Now I can't use the old cost of capital because from 16% old KE it has been raised to 20.9%. Comfortable? Yes, sir. So from the debt 8%, but still it is hanging at how much percent only? 8%, because up to some level of debt the rate will be same. So we can understand that even after we borrow 75 lakhs, sometimes it would have not crossed the leverage limit. Still it may be in the normal limit only. It is in the bearable limit only. That's why the debt holders have not reacted that much. But if you are borrowing 1 more crore, it won't be 8% itself. It may be 10 or 12 or 14 or 16. Are you all really with me? So my dear lovable students, 20.9 into 50% comes to, sir, 10.45 is the weighted KE, and 8 into 50% comes to 4% is the weighted KD. So 10.45 plus 4 comes to 14.45 is the KO. So automatically, once you inject more and more debt into the capital structure, actually KD should react. But in this question, KD has not reacted. But who has reacted well? KE has reacted well. Because of KE reacted, KE increases. Because of KE increases, automatically KO increased from 13.15% to 14.45%. Comfortable? Yes, sir. So this is what they require in this question, my dear lovable students. Before the new proposal, no problem. Before the new proposal, you have to just find out KD is equal to, the value of the debt is equal to I by KD. Very simple. And value of equity is equal to earnings available to the equity shareholders divided by KE. Then you will get the total market value of the firm. So just put the proportion amount column. Then you have to find out the WACC. But after new proposal, this is the new proposal, this is the problem. Actually, they are not injecting equity into the capital structure, but they are injecting debt into the capital structure. So automatically, when you inject more debt into the capital structure, KE increases. Actually, sir, practically, KD should also be increased. Because as per traditional approach, KD will not be same. KD will not be same. Right, sir? Yes, sir. KD should have reacted, but in this question, it has not reacted. It has kept at 8% itself. Hello, sir. So, equity KE increased and KD, sir, which was constant. So, automatically, KO also changed. Comfortable, sir? Are you able to appreciate or understand this question? Sir, we are having only one pending question, question number 7. Once we done that question, we can say that we are done with the chapter cost of capital. What is required in a subject like costing and FM, you have to practice by yourself. Then you will be doing here and there small mistake. That small mistake is our asset. That small mistake shows that we are thinking something. That small mistake says that we are going to pass in examination. To commit that small mistake and to avoid that as a big mistake in the examination, you should have the writing practice. My dear lovable students, redo question number 6 if you gone wrong and try question number 7 before we try question number 7, which is a very easy question, and we can legally say that we are through with the chapter cost of capital. I am waiting here to solve you question number 7. We'll meet at the appropriate time.